Extended S&P 500 legal disclaimer. Important disclaimer. This video is for educational purposes only and does not constitute financial or investment advice. Past performance does not guarantee future results. Please conduct your own research and consider consulting with a qualified financial advisor before making investment decisions. All investments carry risk and you may lose some or all of your money. And TRO, have you heard of the S&P 500 but never really understood what it means? Maybe you thought it's just something Wall Street people talk about. I was exactly like you. 5 years ago, lost in the complex jargon of the finance world, feeling completely overwhelmed. But here's the truth. If you've ever used an iPhone, watched Netflix, or bought toothpaste, you've already interacted with companies inside the S&P 500. Pension funds, insurance companies, and major investors worldwide allocate huge portions of their portfolios to the S&P 500. This shows you just how massive this market really is. In this comprehensive guide, I'll explain everything about the S&P 500, from its fascinating history to advanced investment strategies, and why it might just be the smartest financial decision you make. By the end of this video, you'll understand the S&P 500 better than 90% of investors. Part 1. The complete story of the S&P 500. The S&P 500 stands for Standard & Poor's 500. But the story goes much deeper. It was created in 1957 by Standard & Poor's Corporation, replacing their original 90 stock index. The goal was simple: create a benchmark that truly represents the American economy. Here's what makes it special. It's not just the 500 largest companies. It's a carefully curated list of companies that meet strict criteria. Market capitalization must be at least $14.6 billion as of 2025. The company must be profitable over the most recent 4 quarters combined. At least 50% of shares must be available for public trading. And the company must pass a liquidity test, meaning it trades actively enough. Think about it. Almost everything you use in daily life is represented. Apple. That's your phone and computer. Google. Your search engine and YouTube. Amazon. Your shopping and cloud storage. Microsoft. Your software and gaming. Tesla. The future of transportation. Morgan Chase. Your banking and finance. But here's what's fascinating. The index is market cap weighted. This means Apple, worth over $3 trillion, has much more influence than a smaller company worth $50 billion. The S&P 500 represents approximately 85% of the US stock market's total value. When people say the market, they usually mean the S&P 500. Part 2. Sector breakdown and market dynamics. Let's dive into what's actually inside the S&P 500. Technology dominates at 28%. This includes Apple, Microsoft, Google, Meta, and Tesla. These companies drive innovation and growth. Healthcare follows at 13%. Companies like Johnson & Johnson, Pfizer, and United Health, these benefit from an aging population. Financials represent 11%. Morgan Chase, Bank of America, Berkshire Hathaway. These companies profit when the economy grows. Consumer discretionary is 10%. Amazon, Home Depot, McDonald's. These companies do well when people have money to spend. Communication services. 8.5%. Google, Meta, Netflix, the digital revolution leaders. Consumer staples, 6%. Coca-Cola, Procter & Gamble, Walmart. People always need these products. Every morning with my coffee, I check the S&P 500 first. Because this index doesn't just show me American sentiment, it gives me the pulse of the global economy. When Apple's sales drop in China, it doesn't just affect America, it impacts iPhone users worldwide. When Amazon Web Services grows, it powers businesses globally. The S&P 500 has an average daily trading volume of $150 billion. That's larger than the entire GDP of most countries. Here's something most people don't realize. The index changes. Companies get added and removed based on performance and market cap. In 2024 alone, several companies were replaced to maintain the index's relevance. Part 3. Historical performance and volatility analysis. Now let's talk numbers. Real numbers that will change your perspective on investing. Since 1957, the S&P 500 has averaged approximately 10% annual returns, including dividends. But here's the crucial part. That's an average over nearly 70 years. Individual years can be wildly different. In 1954, it gained 52%. In 2008, it lost 37%. In 2020, despite COVID, it gained 16%. Let me give you some mind-blowing examples. If you invested $1,000 in 1990 and never added another penny, just reinvested dividends, you'd have over $22,000 today. But here's where it gets really interesting. If you invested $100 monthly, starting in 1990, you'd have over $1.2 million today. The power isn't just compound interest, it's consistency during volatility. Let's talk about the major crashes and recoveries. Black Monday 1987 dropped 22% in one day, recovered within 2 years. Dot-com crash 2000 to 2002, fell 49% total. Took 7 years to fully recover. Financial crisis 2007 to 2009, dropped 57%, recovered within 4 years. COVID crash March 2020, fell 34% in 33 days. Hit new all-time highs within 5 months. Here's the pattern. Every crash felt like the end of the world. Every recovery created new wealth for patient investors. The key insight: volatility is the price you pay for long-term returns. without risk. There's no reward. Part 4, ETF comparison and investment vehicles. You can't buy the S&P 500 directly, but you can invest through various funds. Let me compare the most popular options. SPY, the original S&P 500 ETF launched in 1993, expense ratio 0.09 for 5% assets under management, over $400 billion average daily volume, highest of all ETFs, best for active traders who want maximum liquidity. VOO, Vanguard's S&P 500 ETF expense ratio 0.03%, incredibly low assets under management, over $300 billion, best for long-term investors who want minimal fees. IVV, iShares Core S&P 500 ETF expense ratio 0.03%, similar to VOO, but from BlackRock. Best for investors who prefer BlackRock's ecosystem for mutual fund investors. VFIX, Vanguard's Admiral Shares expense ratio 0.04% minimum investment, $3,000, best for traditional mutual fund investors. FXIX, Fidelity's zero fee fund expense ratio 0%, completely free, no minimum investment, best for cost-conscious beginners. The differences might seem small, but over 30 years, a 0.1% difference in fees can cost you thousands of dollars. Part 5, advanced strategies and optimization. Now, let's talk about optimizing your S&P 500 investment. Dollar cost averaging strategy. Instead of investing a lump sum, invest the same amount regularly. Here's a real example. January, invest $500 at S&P price of $4,000. February, invest $500 at S&P price of $3,800. March, invest $500 at S&P price of $4,200. Your average cost, $4,000 per share, even though prices fluctuated. Tax optimization strategies and taxable accounts. Use tax loss harvesting. If your S&P 500 investment is down, you can sell and immediately buy a similar fund like VTI to maintain exposure while harvesting the tax loss. In retirement accounts, this is where S&P 500 investing really shines. In a 401k or IRA, you can rebalance without tax consequences. Roth IRA strategy. If you're young, consider investing S&P 500 funds in a Roth IRA. Your gains will be completely tax-free in retirement. International considerations. For non-US investors, be aware of withholding taxes. Some countries have tax treaties that reduce these taxes. Irish domiciled ETFs might be more tax efficient than US domiciled ones. Rebalancing strategy. If S&P 500 is your only investment, you don't need to rebalance. But if you have other assets, review quarterly and rebalance when allocations drift more than 5% from targets. Part 6, behavioral psychology and common mistakes. This is where most investors lose money, not because of market performance, but because of human psychology. In March 2020, when COVID hit and markets crashed 34% in 33 days, I watched friends panic sell their investments. They locked in massive losses right before one of the strongest recoveries in history. Meanwhile, smart investors kept investing. Some even increased their contributions. 6 months later, they were at new portfolio highs. The biggest behavioral mistakes I see. Mistake 1, waiting for the perfect time to invest. The best time to invest was yesterday. The second best time is today. Trying to time the market usually results in buying high and selling low. Mistake 2, emotional decision making. When S&P 500 drops 20%, it feels terrible. Your brain screams sell everything. But historically, that's when future returns are highest. Mistake 3, constantly checking your balance. Daily market movements are essentially random. Checking your portfolio daily creates emotional stress without providing useful information. Mistake 4, comparing to other investments. Bitcoin is up 50% this year while my S&P 500 is only up 10%. This thinking leads to chasing performance and taking excessive risks. Mistake 5, stopping contributions during downturns, market crashes, or sales on future wealth. If your favorite stock went on sale for 50% off, you'd buy more, not less. The psychological key, think like a business owner, not a gambler. When you buy S&P 500, you're buying small pieces of America's 500 best businesses. Part 7, building wealth with the S&P 500. Let me show you how ordinary people build extraordinary wealth using just the S&P 500. Case study 1, the teacher. Sarah, an elementary school teacher, invests $300 monthly in VOO starting at age 25, at historical 10% returns. By age 65, she'll have over $1.9 million. Total invested, $104,000 to $4,000 investment growth. Over $1.7 million result, millionaire teacher case. Study 2, the late starter Mike starts investing at age 45, with $1,000 monthly. By age 65, he'll have approximately $650,000. This shows why starting early is crucial, but also that it's never too late. Case study 3, the aggressive saver Lisa, invests $1,000 monthly starting at age 25. By age 65, she'll have over $6.3 million. The key insight, time and consistency matter more than investment genius. Here's the most important wealth building strategy. Automate everything. Set up automatic transfers from your paycheck to your investment account. Invest the same amount every month regardless of market conditions. Many brokers offer automatic investing. You can set it up once and never think about it again. This removes emotion and ensures consistency. Part 8. Risks and limitations. No investment is perfect. Let's honestly discuss S&P 500 risks. Concentration risk. The top 10 companies represent about 30% of the index. If big tech crashes, the whole index suffers. US-only exposure. The S&P 500 only includes US companies. You miss growth in international markets like India, China, or Europe. Market cap bias. The index is weighted by size, so it can become overweight in expensive companies and underweight in value opportunities. Sector concentration. Technology is 28% of the index. If tech falls out of favor, returns could lag for years. Inflation risk. In high inflation periods like the 1970s, stocks can struggle. Real returns might be negative for extended periods. Sequence of returns risk. If you retire during a major crash, it can severely impact your wealth even if markets recover later. How to address these risks? Diversify globally. Add international funds like VXUS at value exposure. Consider funds like VTV include real assets, REITs, and commodities can hedge inflation. Have bond allocation, especially important near retirement, but remember, the S&P 500 has survived every crisis in 70 years of history. World wars, recessions, inflation, deflation, technology bubbles, housing crashes, pandemics. Through it all, patient investors were rewarded. Part 9. Global perspective and alternative. While the S&P 500 is excellent, it's worth understanding. Alternatives. Total stock market funds like VTI include smaller companies beyond the S&P 500. This adds about 3,000 more companies for broader diversification. International developed markets like VIA provide exposure to Europe, Japan, and other developed countries. These markets sometimes outperform US markets. Emerging markets like VWO invest in faster-growing but riskier economies like China, India, and Brazil. Factor investing targets specific characteristics like value, momentum, or quality rather than market cap weighting for most investors. A simple portfolio might be 70% VTI total US stock market, 20% VXUS international, 10% BND bonds. This gives you broader diversification while keeping things simple. But here's the truth. The S&P 500 alone has been sufficient for building wealth. Warren Buffett's advice to his wife's inheritance: put 90% in S&P 500 index fund, 10% in government bonds. If it's good enough for one of history's greatest investors, it's probably good enough for most of us. Part 10. Practical implementation guide ready to invest. Here's your step-by-step action plan. Step 1. Choose your account type. Taxable account. For money you might need before retirement. For -O-1-K, if your employer offers S&P 500 options with matching traditional IRA. For tax deduction now, pay taxes later. Roth IRA, pay taxes now. Tax-free growth forward. Step 2. Select your broker. Fidelity offers FXOX with zero fees. Vanguard, home of low-cost investing. VO Schwab, excellent customer service. SPLG Robinhood, simple interface for beginner. Step 3. Choose your fund for simplicity. Pick one S&P 500 fund and stick with it. VOO, IVV, or SPY are all excellent choices. Expense ratios under 0.1%. Step 4. Automate your investments. Set up automatic monthly transfers. Start with whatever you can afford. Even $50 monthly, increase by 1% each year, or with pay raise. Step 5. Ignore the noise. Don't check daily prices. Don't react to market news. Don't try to time the market. Just keep investing consistently. The hardest part isn't picking the right fund, it's sticking with the plan during market turbulence. Part 11. Advanced topics and future considerations. Let's discuss some advanced concepts. Dividend reinvestment. Make sure your S&P 500 fund automatically reinvests dividends. This compounds your returns over time. Tax-loss harvesting in taxable accounts. You can sell losing investments to offset gains. This is more complex with index funds, but still valuable. Asset location. Put tax-inefficient investments in retirement accounts, tax-efficient ones in taxable accounts. S&P 500 funds are relatively tax-efficient. Retirement withdrawal strategies. The 4% rule suggests you can withdraw 4% of your portfolio annually in retirement. With S&P 500 returns averaging 10%, this provides a margin of safety. Future considerations. The S&P 500 will evolve. New companies will be added, old ones removed. Technology, healthcare, and clean energy might become larger sectors. Artificial intelligence and automation could change which companies dominate. But the beauty of index investing is that you automatically own whatever companies are succeeding. ESG considerations. Some investors prefer environmental, social, and governance-focused funds. S&P offers ESG screened versions of their index. Inflation protection. While stocks generally outpace inflation long-term, consider iTips or real assets if inflation becomes a persistent concern. Conclusion and call to action. We've covered everything: the history, the math, the psychology, the strategies, and the implementation. Now you understand what the S&P 500 really represents, why it's been America's wealth-building machine, how to invest in it efficiently, common mistakes to avoid, advanced strategies for optimization, the risks and how to manage them. Here's the bottom line: the S&P 500 isn't perfect, but it's been one of the most reliable wealth-building tools in history. Remember, every great fortune started with the first dollar invested. Whether you start with $50 or $5,000, the important thing is to start. Inflation exists everywhere. Money sitting in savings accounts loses purchasing power daily. Investing in growing assets like the S&P 500 is actually protecting yourself from inflation. Your assignment: open an investment account this week. Start with whatever amount you're comfortable with. Set up automatic investing. Then forget about daily market movements and focus on your long-term goals. Next video, I'll show you exactly how to build a complete investment portfolio around the S&P 500, including international diversification, bond allocation, and tax optimization strategies. The journey to financial freedom starts with a single step. Take that step today. Comment below. What's holding you back from investing in the S&P 500? I'll personally respond to help you overcome any obstacles. Like this video if it changed your perspective on investing. Subscribe and hit the notification bell for more wealth-building content. Share this with someone who needs to start investing. Financial education is the gift that keeps on giving. Remember, time in the market beats timing the market. Your future self will thank you for every dollar you invest today. In upcoming videos, we'll cover tax-advantaged investment accounts, international diversification strategies, and how to build $1 million portfolio from scratch. We'll walk this path to financial freedom together.